Hello everyone, I'm Finance Dean Smith. Today we've got four major stories to break down. First, SpaceX's Starship just nailed its 10th test flight. Does this mean Musk's ecosystem is finally closing the loop, and what could that mean for Tesla's stock price? Second, the historic antitrust ruling against Google and Apple is about to drop. Will this be a crushing defeat for Google, or could it turn out to be a blessing in disguise? Third, there's a hidden force even bigger than retail investors and hedge funds that's been propping up the US stock market. Who's behind it? And finally, Nvidia's latest earnings beat expectations, but its stock tanked. Did the market misjudge Nvidia, or is Wall Street misjudging itself? We'll unpack all four stories tonight, so give this video a like before we dive in and let's get started. Today, US markets were fairly quiet. The S&P 500 gained 0.29, the Nasdaq was up 0.21, and the Dow rose 0.40%. By sectors, energy led with a 1.14% gain, tech added 0.48, real estate rose 0.43%. While other sectors saw only minor moves, yesterday SpaceX's Starship successfully completed its 10th test flight. And for the first time it demonstrated payload deployment in space, releasing simulators for 8 Starlink satellites. For space enthusiasts, this is a huge milestone. But as investors, we need to ask, what does a rocket launched in Texas have to do with Tesla's stock price? The answer might lie in the Musk ecosystem that's rapidly closing the loop. Let's recap. On August 26th, Starship's test achieved all major goals. Successful ignition of all 33 Raptor engines, stage separation, booster landing, and second-stage orbital insertion. But the most commercially significant achievement was that satellite deployment test. Now here's why it matters. SpaceX says Starship will eventually be able to launch its next-gen Starlink V3 satellites, and just one launch could add over 60 Tbps of network capacity. That's 20 times more than Falcon 9 and more than the combined capacity of all other US satellite providers today. So Starship is a game changer for satellite deployment efficiency. But what about Tesla? Morgan Stanley's auto analyst Adam Jonas argues that a stronger Starlink network means Tesla's SSED and robotaxi can run even in remote areas, always connected. More importantly, it means Tesla gets access to unique driving data collected in off-grid regions, further training its AI systems not just for cars, but also for Optimus, the Tesla humanoid robot. Ultimately, this could help Tesla shift from being valued as just a carmaker to being seen as an AI and robotics company. That's the long-term vision. But for now, SSE's penetration rate is still only around 10-15, and robotaxi operations are limited to Austin, Texas. So while Starship's success is a massive milestone for SpaceX, it doesn't directly move Tesla's stock, at least not yet. Now let's move to Google. Imagine this, a company loses a lawsuit but ends up saving $26 billion a year. Sounds bizarre, right? That's exactly what could happen to Google. Here's the story. Since 2020, the US Department of Justice has been suing Google, accusing it of maintaining its monopoly by paying billions to make its search engine the default across devices. Apple alone gets around $20 billion a year from this deal. Last year, the court ruled Google's practices were illegal. Now, Judge Amit Mehta is expected to announce the final remedy soon, likely forcing users to choose their own default search engine. Will this hurt Google? Probably not much. Apple's VP testified that Bing couldn't replace Google because Google simply delivers better results. And in Europe, where regulators already forced a similar choice screen, Google's market share barely budged, still around 90%. This is what economists call a natural monopoly. Google's scale gives it better quality, and that quality reinforces its scale. So instead of losing, Google might actually win. By no longer paying Apple $20 billion annually, it can redirect that money into AI, Gemini, and cloud services. Analysts even believe this could make Google one of the best performing stocks next year. That said, the real risk for Google isn't this lawsuit, it's AI search. In traditional search, Google dominates. But in AI search, competition is fierce, with many strong alternatives emerging. So while the ruling may ironically free Google, the battle in AI search is just beginning. Now let's talk about the biggest buyer in today's stock market. It's not retail traders, it's not hedge funds, it's corporations themselves. We're witnessing a historic trillion-dollar stock buyback wave. By August 20th, US companies had announced over $1 trillion in buybacks just in 8 months. Apple alone announced $100 billion in May, while Alphabet pledged $70 billion. Major banks like JP Morgan, Goldman Sachs, Wells Fargo, and Citi also joined with programs over $40 billion each. Why are companies doing this? Simply put, profits and cash. They're generating so much money that after covering expenses, they still have massive reserves, and buybacks are the easiest way to return that wealth to shareholders. This trend could reach $1.3 trillion announced buybacks this year, with around $1.2 trillion actually executed by next year, but not everyone is happy. U.S. Treasury Secretary Janet Yellen recently criticized Boeing for favoring buybacks over R&D, and even Warren Buffett, whose Berkshire Hathaway now holds a record $344 billion in cash, hasn't repurchased shares for 4 straight quarters, suggesting he's waiting for cheaper opportunities. In the short term, buybacks act as a safety net for stock prices, but in the long run, if companies neglect R&D, they may weaken their future competitiveness. Apple, for example, keeps pouring billions into buybacks while lagging behind in AI, something that could make it very vulnerable down the road. Finally, Nvidia. The company just released its Q2 earnings for fiscal 2026. Revenue came in at $46.7 billion, up 56% year over year, beating expectations. Gross margin hit 72.4, also better than expected. EPS was 108, beating estimates of 101. Sounds great, right? So why did the stock plunge? Because the data center business, Nvidia's core growth driver, posted $41.1 billion, slightly below expectations of $41.29 billion. That tiny miss triggered a 5% drop after hours. Here's the reality: at Nvidia's sky-high valuation, Wall Street no longer settles for meeting expectations. It demands huge beats every quarter. Still, guidance looks strong. Q3 revenue is projected at $54 billion, with margins rising to 73.3%. And that's without including any revenue from China's H20 chips. CEO Jensen Huang also stressed that demand for the Blackwell architecture is ramping up fast. With Ruby chips already in production for 2025, he even suggested China could be a $50 billion market opportunity, depending on U.S. export approvals. Meanwhile, Nvidia expects global AI infrastructure investment to hit $3.4 trillion by 2030, with $600 billion this year alone. And yes, Nvidia also announced a $60 billion stock buyback plan, joining Apple and Alphabet in the repurchase frenzy. So while short-term sentiment dragged the stock down, the fundamentals remain solid and perhaps even stronger than before. So to recap, Musk's Starship success shows us the long-term vision of Tesla's AI ecosystem, but it won't move the stock today. Google may lose in court but win financially with more firepower for AI. A trillion-dollar buyback wave is reshaping the market. With corporations themselves as the biggest buyers, Nvidia's stock dip was more about Wall Street's inflated expectations than real weakness in the business. That's all for today's show. If you enjoyed this breakdown, don't forget to like the video before you go. I'm Finance Dean Smith, thanks for watching, and I'll see you next time.